All right. Thank you all so much for coming. We're going to get started. I'm Meg Marco. I'm the editor-in-chief of Observer, and I had the distinct privilege of editing Jim's piece that inspired this very dramatically named, but I think very interesting panel that we are going to have today, where we first announce the death and then discuss the future sort of post, will VC go to heaven? How is it going to happen after it dies? We do have one sort of sad but happy announcement. Sam Lesson is not able to join us today. He has an incredible excuse, though. I think, Jim, you wanted to make the announcement of the excuse. So,
yes,
Jim,
sure.
take it away.
I'm happy to. I got Sam is nothing if not diligent. I got a note about 24 hours ago saying that the third baby was just about to be born, and I think was born last night. Little baby Wilder Lessons. So we're sad not to have Sam with us, but we wish him and Jessica all the best.
Yes, incredible excuse. Obviously, a good use of his time. Done with that. But one of the reasons that Sam was joining us is that Jim and Sam were sort of in like violent agreement about some things, and so we hope that Jim will be able to sort of like bring some of Sam's piece into the conversation as well and sort of channel him in his absence. So thank you for that. Just wanted to quickly go around and introduce our speakers. James Ledbetter, Chief Content Officer of Clarim Media, editor and publisher of Fin, formerly Chief of Content at Sequoia and editor-in-chief of Inc. for 5 years. So really interesting perspective on all of that stuff. Very interested to hear you talk about your piece. And one of the subjects interviewed in the piece, Blair Silverberg, founder and CEO of Hum Capital. You got the kicker quote, I believe, in the piece. Very interested in interrogating you further. Loved your contribution to that, and hoping that you can kind of give us a feeling about why you started Hum and how you are going to handle the death of VC since we've declared it to happen. All right. So just to kick us off, I wonder if we could just spend like a little bit of time on the premise of the piece. Jim, if you'd like to start, why did you pitch this? I had the privilege of editing it, but what was the moment where you said, okay, I really want to write something?
It's one of those things where you perceive over a period of a few months several different data points that just suddenly kind of click in your head, and you say, hey, this is an actual trend. And I would like to say that I had this thought uniquely, but actually while I was still working on the first installment, Sam came out with his piece in The Information in August, which was called "The End of Venture Capital as We Know It." And the factors are a few. One is that I think the way to think about the death of venture capital, which is obviously an exaggeration, is that it's the victim of its own success. Venture capital has been one of the most powerful, most dynamic forces in kind of the global economy for the last half century. And it typically involves very large institutional investors who put money into funds created by VCs that then get invested into essentially any tech company that you can name, and a whole bunch that you can't, and other industries as well. But obviously, it's very, very much identified, and properly so, with the growth of the tech industry of Silicon Valley. That has been tremendously successful for decades for everyone in the chain. It's great for the entrepreneurs because they get money and then they create these companies that are worth billions of dollars. It's great for the limited partners who put the money in because they get fantastic returns. Often these funds will kick back 5 times what someone puts into them, and there are very few legal ways to make that kind of money, no matter how you created that wealth to begin with. And then of course the middleman is the venture capitalist herself, who's also done pretty well for the most part. But what's happened over time is that model has started to sort of chip away. And we can talk a little bit more about that. But also it's created so much wealth that you now have a class of people who have built tremendous personal wealth on the back of VC-backed tech who now themselves want to be the investors, and they're creating their own little funds or solo VCs, and so that's then we have the growth of a crowdfunding, crowdsourcing. We have the kind of debt funding that Blair helps to facilitate. So there are all these different ways. Plus you have the entry of kind of players from outside that Menlo Park, Palo Alto, a stretch of highway, people like Tiger, people like SoftBank who've come in with very, very deep pockets. All of these little kind of threats and pings at the traditional model are kind of what led people like Sam and me to say, hey, this thing is dead.
Yeah. And Blair, would it be wrong to suggest that the things that Jim is describing are also why you founded your company, or would that be incorrect to say? Or what was the moment when you realized that you had to found the company that you have?
I would, at a high level, be correct to say yes. So I was a venture capitalist at Draper Fisher Jurvetson. I was working very closely with Steve Jurvetson and Tim Draper, and was really educated on how the venture ecosystems evolved over the years. Because when both of those guys got started, let alone Tim's dad, I think Tim is like a third or fourth generation venture capitalist. In the early days, it was an investor puts up the capital, an entrepreneur puts up the time, they split the company 50-50, and you hope it works. And if it doesn't, that's okay. That's one of the beautiful things about the culture of failure in Silicon Valley. We'll just go on and we'll try something else again. And when you think about financially what that is, it's an option. You should have a very high payoff for the things that work, and those cover up the losses that are zeros. And what I was observing as a venture capitalist is that most of the things that my colleagues and I were funding didn't look like options. They looked like businesses that had a couple $1 million of recurring revenue with predictive kind of clear sales and marketing performance data. And you could actually build a financial model and project them forward and say, okay, this business has demonstrated that it can grow efficiently in the past. If that continues in the future, it'll be worth X. That is not venture capital. But these businesses were being financed as if they were taking on venture risk. And I saw a lot of the same things that Jim saw. One of the things that struck me most, I've been a huge fan of Peter Thiel's for a very long time. And when Founders Fund wrote this, what happened to the future piece that they put all over the website, I think it's still there to this day. Yeah. I felt the same way. I was like, why are we applying this option-based, highly levered, highly risky form of financing to businesses that if they were just a little bit bigger and were in a space called industrial or service, instead of called software, would be raising money at 8% from banks and insurance companies and so on and so forth? It just didn't make any sense to me. And then as I had a bunch of experiences over the years and saw entrepreneurs exit their companies in the same industry, often owning wildly different percentages of their companies based off of how they financed them, it really didn't make sense. To me, it felt almost like an injustice or like a source of corruption. Like, how can entrepreneurs who put in equal effort arise and get equal exit values exit a company and own wildly different percentages of it? That's just financial inefficiency. That should go away. So I felt compelled to start Hum to help entrepreneurs optimize how they finance their businesses and have more predictable results, and ultimately to fix a lot of the corruption that occurs in capital allocation, which I can talk about for hours. I won't bore the audience with too long of a monologue on this, but we don't think enough about the daily acts of corruption that happen when we allocate capital. And who knows how fast GDP could grow if we allocate capital well. Allocating capital to Theranos and WeWork is not allocating capital well, yet it continues to happen in our economy day in and day out. And so somebody should be fixing that problem, and that's what we're working on.
I have an unlimited appetite to talk about corruption. So the idea that I would be bored is very silly. But I think we should talk about sort of like the elephant in the room thing, which is I think that happened in between the two pieces, between part one and part two, which was the announcement that Sequoia was restructuring the way that it would do business. And so I think I want to start with Jim, so you have some experience with that company and maybe some insights to share about that. What was your reaction to that? Did you see that coming? What do you think of it?
It's a great question. I had no advanced knowledge that this was in the works. It was not. If it might have been in the planning when I was working there, but nobody talked to me about it, which is totally understandable. I will say that when I worked there, there was a kind of overarching anxiety about seed funding, and the feeling being that Sequoia did not get enough of the looks at really early stage companies, and that therefore they were kind of missing out on maximizing what they can get over the cycle of a company, for lack of a better way of putting it. But I actually don't think that their announcement recently is necessarily connected to that. It might be, but I think it's motivated by some other things. So just for those who haven't followed this closely, a few weeks ago, Sequoia announced that essentially that it is no longer a venture capital fund, both kind of legally and functionally. And what do I mean by that? And I think probably Blair knows this a little better than I do, but in order to be registered as a venture capital fund, you get certain advantages. You get tremendous tax advantages, and very loose kind of reporting requirements. But there are restrictions on how you can invest the money that you're sitting on. You have to invest a certain percentage of it in companies. You can't just say, I'm going to take this money and buy trees or buy stocks or buy whatever. And so they are now registering as a investment advisor, which is, I believe Andreessen Horowitz and SoftBank are already using that. So now they're pretty unrestricted in terms of how they invest their money. The other interesting thing that they're doing is, traditionally what VC firms do is they raise money for a particular fund, right? It would be like Hum Capital Fund 1. And that fund would raise, let's say $100 million. And over the course of, say, 5 to 7 years, they're investing in companies. And then when that money runs out, the fund is closed. When the fund closes, that's when the payments go back to the limited partners. That's the kind of the payday based on the performance of the companies that the fund has invested in. Sequoia is on, I don't know, Fund 14 or something like that. But that's all going away. Now, what I'm saying doesn't apply to China, but the United States and Europe, all Sequoia's money will go into one big fund that never closes. Some people call this a rolling fund. And I think the limited partners get an opportunity once per year to cash out if they feel like, okay, we've done really well. It's like, now's the time to get out, and maybe we'll get back in. So it's a very, very different structure. To me, I'm curious to know what Blair thinks about this. The jury's still out whether that kind of remake will make sense for other big VCs. It might be Sequoia specific, or maybe there's one or two others that would be positioned to pull that off. But I don't know that it's going to like cause this avalanche of other VCs to do the same. But we'll see.
Blair?
Yeah, I think that the most important thing to realize about what Sequoia is doing is just to put Sequoia in context relative to other asset managers. And so Sequoia is 17 times smaller by assets than Blackstone, which is the largest private asset manager. It is about 237 times smaller than BlackRock. Not all asset managers start with the word black, but those two happen to be the biggest in their respective categories. And it's very normal as a business becomes a large asset manager to change the way that they structure their funds and their operation. And sort of the holy grail is permanent capital, where investors can withdraw and close down the fund tomorrow. They can invest over a very long time frame as a result, with the lowest possible cost of financing. And so what you've seen, like in the hedge fund space, for example, which became very, very popular in the the 90s and early 2000s was people setting up captive insurers to use insurance flow to fund their business. You get to a point when you have meaningful assets under management, typically on the order of $10 billion under management, where it actually can make more sense to make financial engineering decisions ahead of good investment decisions for a period of time. And once you get your cost of capital optimized, then of course you have to go back to optimizing the kinds of investments that you're making. So I think we're basically just seeing that with Sequoia, like you would expect of a business that's in the tens of billions of dollars of AUM. And to Jim's point, most VC firms are not in the tens of billions of dollars of AUM. So I don't think you'll see this shift from many other venture firms, but from the large ones, perhaps NEA. I think it would be a very normal thing to see.
Yeah. I should say that in Sam's piece that ran in August, while he didn't quite predict that, he did talk about, just as Blair says, that VC in order to survive has to stop being VC. It becomes a small fish in a larger pond, where it's now swimming with other asset managers like hedge funds, private equity, et cetera. So this is very much in line with what Sam wrote. And I think there's a one missing piece here that Blair alluded to somewhat about inefficiencies, is that there was a time when software was kind of less dominant in the world than it is today, that venture capitalists provided some things that were very hard for an entrepreneur to get in other places. How do you value this business? It didn't exist before, so no one really knows how to value it. We're talking about the 1980s. How do you evaluate an online business when online is a brand new thing? Over time, those things have become quite commoditized. I mean, that kind of knowledge of how to value these things, what's going to happen to these companies, et cetera, is now probably something that machines can do. And so the distinctiveness of VC has been shrinking and shrinking and shrinking, while all these other players are growing and growing and growing. So it is, I think, Sam, this is a provocative comparison, but it's certainly an interesting one. He talked about the whaling industry in the 19th century, which was where actually some of the original kind of venture capital came from, where you had all these people going out off the shore of New England to kill whales. Why did we kill whales? Because we needed the oil. We needed the oil to fund the Industrial Revolution, basically to fuel the Industrial Revolution. Once it was discovered that you can find oil in the ground, that became a much more efficient way of getting oil, and the whaling industry, which was one of the largest industries in the world, disappeared. Not quite overnight, but more or less overnight. And that's Sam's comparison to kind of what's happening to VC now, which I think is, like I said, provocative.
I think some of the examples that you use to put this in context were sort of like, everyone wants to talk about sort of WeWork, and I agree with you that was not the most efficient use of capital that I've ever seen. But some examples from your first piece, Jim, where you're like, well, kind of goofy allocation of capital to like not the greatest ideas is not a unique to the recent past phenomenon. Right. You used some great examples. I don't want to scoop you, but if you want to talk us through some of those in that context, that'd be great.
Yeah, I mean, I was around covering the .com revolution of the 90s, and I watched some pretty silly companies get like massive amounts of venture capital. I mean, again, in context, if I don't have my piece in front of me, but if I recall, the original Sequoia investment in Yahoo, which is not a small company, was $2 million. I mean, $2 million now an entrepreneur can find on the street. I mean, it's just a ridiculously small amount of money compared to the kind of deals that get done today. But you had, companies in the 90s. I mean, pets.com is sort of a poster child for some of this. There was a company called alladvantage.com, which got a huge amount of venture capital from very respectable firms that kind of, I mean, it was a service that sort of paid people to surf the web, and it ended up as a way of like making you spam your friends. It was kind of a disaster. But yeah, I mean, I think one of the critiques to be made about the venture capital world is what I call the frivolity critique, that you have all of this capital chasing some stuff that it's really not clear the world really needs. And to Blair's point, if the world does need it, they can still probably find capital at a cheaper rate somewhere else. What you needed venture capital for in the 70s and 80s was stuff that was so out there that no one would fund it, or basically no one would fund it, which is why you would give up 20, 30, 40% of your company, because that was the only place you were going to get funding. That's no longer the case today. Really, $1 billion, more than $1 billion a day is invested by venture capitalists. Like, there is so much money floating around out there that's probably not even what drives the decisions that entrepreneurs make. They kind of assume that they can get the money. Now it's like, well, what else can you give me?
I guess I have sort of a question about that. And like, do you feel that that model sort of incentivizes me as a business owner to come up with sort of a world-changing ideology around my like smoothie business or whatever it is that I want to do, that's a sort of very milquetoast, like not a software company? But if I can say I'm changing the world, then perhaps I could, get access to that $1 billion a day, and that is creating an efficiency.
I just want to say that I think that that's a very optimistic view of what's going on. I wish that the more world changing the idea, the easier it was to access the $1 billion of capital. But actually, it's very much not the case. I think that what we're seeing is a lot of money going into recurring software businesses, because the world has basically figured out that those cash flows are sticky and that those businesses become profitable over time. And so you can basically adjust medium-sized software business and say, it's going to produce a lot of EBITDA, and I can finance that EBITDA today, without taking a lot of risk on growth 6 times, when if I were doing a buyout, now I'm having to pay like 10 or 12 times. So it's literally just kind of a financial arbitrage. Financial arbitrages are not meritorious of venture capital. And by focusing venture capital on those kinds of businesses, we're actually robbing society of the opportunity to fund riskier technologies that move the world forward. And when you look at places like China legislating the number of hours that kids can spend on technology or on gaming, after school, there's a global competition out there to fund breakthrough technologies and integrate them into your society. And we're sort of robbing ourselves of the opportunity to do that in an environment that, because of low interest rates, is very lucrative to not do that. You totally can't fault funds chasing the highest returns. But back to the Peter Thiel article, like, somebody has to stand up and say, let's allow venture capital to migrate away from the better understood risk profiles like software businesses and back to riskier things, which move society forward more. And there are some venture capitalists who do this day in and day out just because they love to change the world. And so, one of my favorites, who happens to be my biggest investor at Hum and a mentor and colleague from the past, is Steve Jurvetson. And Steve has a choice to fund any business he wants, but he prefers to fund businesses like SpaceX and Tesla because he thinks that's going to move the world forward. And by the way, it's very lucrative to do that. It's harder. So you have to learn how these technologies work. I mean, this guy is an unbelievable polymath and actually understands how chips work and why photonics are sometimes, a better technical choice, and, how to actually create a rocket. Like, you have to do hard work to fund those kinds of businesses. But the result is the kinds of return profiles that venture has gotten known for. They're still available today. World-changing inventions coming to market, which there's sort of infinite potential to do that. And a world that's just a much, much better place. And if venture were to make a more concerted effort to focus on those kinds of companies, actually cheaper financing would open up for businesses that are less risky, which is how you ultimately mature an industry. So I think it's just important to mention, like, this is just a choice we are choosing to make. And we very well, America very well may lose the technology war against China as a result. I kind of take it personally, because I think it's just such an important thing for our society to do a better job at, and we're sort of missing the forest through the trees.
So Jim, the example in your story was of a company that is not going the VC route, but which does have kind of an idea that feels like it could really change the world. So I'm wondering what your reaction is to what Blair is saying and how that fits maybe into the example that you used, which you should introduce to the
Yeah, so
audience?
I came across this really fascinating company called Combinator, and they're quite new. I think they've been operating for about 2 years, and they do a very cool thing, which is they rake seaweed off of Caribbean beaches. Left unraked, this stuff just sort of sits around and rots, and it's smelly and it scares away tourists. But it also emits methane gas, which for those of us who've been paying attention to Glasgow for the last few weeks, methane is a really horrible greenhouse gas, much worse than carbon dioxide, many times worse. And so they're sort of taking methane out of the environment, which is an environmental plus on one side, and then they use the seaweed to create a variety of products, many of which would otherwise be produced by petroleum. So it's sort of double sustainability. And in this moment of climate tech, I genuinely think that if the founders went to Sand Hill Road, that they would have little trouble attracting venture capital, but they didn't. And I think the reasons that they didn't are very instructive. One is that I don't think they wanted to give up, again, 20, 30, 40%, depending on where you are in the life cycle and what kind of terms you get. I don't think they wanted to give up that much money, number one. Number two, there was a green cycle about 10 years ago in Silicon Valley, 10 to 15 years ago, where a lot of VC firms felt that they got burned. They made some bad investments. And as a consequence, you have VC firms who don't necessarily have people on staff who are experts in this kind of stuff. You might have individual firms where they are, but in general, it hasn't been a focus of Silicon Valley's very much for the last 10 years or so. Now that's changing a little bit. Chris Sacca, for example, has started a fund that invests only in kind of carbon neutral, carbon positive technologies. So you're seeing a bit of a comeback as the world moves toward ESG and all of that. But they didn't necessarily feel that there was expertise out there that they were missing out on. So what they did instead was, and this is actually a nice segue into getting Blair to talk more about Hum, is they were able to find a family office with a venture arm, small-ish venture arm, that specifically wants to invest in companies like this. So they're getting both mission and money and expertise, and not giving up as much of their company as they would if they went the VC route. The other thing that they did was they made available through WeFunder the ability for anybody to invest in this company for, I think it's $100, $150. You can go on WeFunder and see. And while they admit that is not a way to bring in a lot of money, it is a very effective form of marketing. It's a self-selecting audience of investors. Like, these people care enough about your company to give you $100. That's a very committed person. And down the road, whether they make money off of it or not, they're going to talk about it. They're going to tell their friends about it. I ended up writing about it because that's how I learned about comedy. So that kind of marketing, that kind of publicity is not necessarily something that every VC firm can give to its entrepreneurs, its portfolio companies. So I really think that this company sort of typifies where we're at in terms of the relationship between a founder and a VC these days, which is very different than where we were 20 years ago.
Blair, you're cue to talk about Hum.
Yeah, I mean, I think so. I think it's really important to recognize that the market for capital is global. It's the global capital marketplace. Yet there are these pockets that are common places that entrepreneurs may look first for capital. And kind of like before kayak existed, it's kind of interesting. There's about 5,000 airlines globally. There's about 20,000 private equity firms, private credit firms, endowments, foundations. There's 5,500 in the U.S. Banks that make commercial loans. It's kind of a similar market or ecosystem. Tens of thousands of possible options for you to choose from to get from point A to point B. And so in travel, of course, there is kayak. You don't have to call up 5,000 airlines to figure out who has the best price. You just go to one place and you say where you're going, and the best prices come to you. In the market for global capital, the same should be true. You shouldn't have to go drive down Sand Hill Road and worse, network your way into a club of people who you may not know, particularly if you're a company that's not based in Silicon Valley. If you are serving people that are underrepresented in the mix of venture capitalists, which is something that's been written about quite a bit, it can be quite hard to access that type of capital. But in a world where there's literally tens of thousands of options for you, you should have a kayak-like option. And essentially that's what we've built at Hum. So today, for example, we announced we now serve equity. So we help companies basically raise equity or debt. For the equity piece, we're a broker-dealer. So we act as a marketplace that matches companies to equity investors. For debt, we do the same thing. What we found is kind of like has happened in the public markets, there's a lot of demand actually. So if you talk to private fund managers, one of the most common things you'll hear them say is, my LPs are trying to co-invest. What co-investing is going around the fund that you're invested through to invest directly in companies in partnership with them so that you can get lower fees. It's been very well established in the public markets that managers generally aren't worth the fees you pay. They create a little bit of alpha, but not relative to the fees they're charging. So in the public markets, what's happened is today, literally 50% of public market capital is allocated passively through rules-based instruments like ETFs. If you want to, for example, if you ask Warren Buffett where you should put your money, he will say in an index fund. If you want to get exposure to the S&P 500 index, that costs you 5 basis points, not 2 and 20. If you want to get exposure to a company that Tiger is investing in, for example, it costs you 60% in fees versus 5 basis points. What's it, like 1,200 times difference? So I think it's really important to point out that the way that markets mature is by giving the end owner of balance sheet capital direct access to the place that the money is ultimately going. That has happened in the public markets. It's starting to happen in the private markets. It's early innings, but there's some trends I can talk about that I think will make it go quite a bit faster in the privates than happen in public. But all of this is to the benefit of society and to entrepreneurs. So cheaper capital is better, more available capital is better, more diversity in the types of capital that you can mix together to optimize how you finance yourself is better. Lower fee structures are better. That's more money to reinvest in companies. So this is all great stuff, but it is a revolution, and it's just completely changing the way that the private market finance has happened.
So this sort of reminds me of an issue that we talk about a little bit in the piece, which is the sort of diversity issue. And the way that we talk about it here is similar to the sort of cliche in journalism, which is news is what happens to the editor. And you don't want to have a publication where news is what happens to the editor. And good ideas for funding are what happens to the VC. So like if the VC can engage with it, if there's sort of social proof, if it makes sense to that person, then they're more likely to get that very risky funding. But that may, to your point, not be the best way to fund things that are not for you or not for me, but have data to back up that there is demand in the marketplace for whatever this thing is. Can you talk a little bit about that and how you hope to solve it?
Yeah, so this is a really important point. So data wins, basically. And data ultimately wins when it becomes available. And so what's happened in the private markets over the last really 10 years is that the commercial adoption of SaaS platforms, like software as a service platforms, that manage things like your accounting data, online banking, your sales pipeline, i.e. Salesforce, your web analytics, what people are doing on your website, what they're doing on your mobile app. I mean, order management systems, like literally all of the tools that are required to run a business are now in the cloud. 75% of businesses run on cloud-based systems of record. So it turns out that in 2021, you can just kind of like you do for Quicken or Mint.com, ask entrepreneurs to say, hey, I'd love to understand your business better. Would you be willing to let me connect into QuickBooks so I can scan what's in there and understand what's going on? And thousands and thousands of companies have done this with us. They are completely happy to have us take a data-driven perspective when looking at their business. And what you see is very clear indicators of success. So a business is clearly financeable. You see this without having to make a deck. So the company doesn't have to make a presentation, without having to have an auditor come in for $250,000 and validate all of this stuff is true, which has to happen in literally every kind of meaningful financing, say over $50 million in size. So the data actually tells the story. And then what immediately happens is it's quite unimportant as a financier whether I really get what's going on with the product or not. Because like, I don't need to know, the inner workings of a product that is selling at a ridiculously high LTV to CAC month over month over month over month with thousands or tens of thousands of customers. I don't really need to understand it to finance it, especially not in the portfolio. And so that creates much, much more equality in financing opportunity, because what you probably caught from this is now it's irrelevant what the gender is of the founder. It's irrelevant what state the company is headquartered in. It's irrelevant if the founder went to a school that I'm familiar with or like or donate to. That just doesn't matter anymore. And this is how finance should work, and this is how the public markets work. This is ETFs. These are quant funds. So this is starting to happen in the private markets, basically based on the back of this SaaS explosion. So we're just facilitating that as a marketplace.
I think Blair, you told me a few weeks ago, you came out of Stealth in May, if I recall correctly, and are now able to talk about the geographic distribution of the companies that you're funding. And I found that really, really interesting, and I think the audience here would too. If you could share that.
Yes, so we've worked with thousands of companies. I think the official number is like something like 2,700, but thousands and thousands of companies. We have companies in 47 out of the 50 states in the US. Half of our companies are outside of Silicon Valley and New York. So companies that are not in the major venture ecosystems. By the way, Silicon Valley is maybe a slightly dated statistic, but Silicon Valley allocates about 80% of the country's venture capital. So there's obviously a huge mismatch between where companies are and where the funding occurs. We don't systematically track other factors like gender, so on and so forth. I would love to, but I can just say from knowing our entrepreneurs that there's a lot of diversity in industry and profile of the founder, and that diversity is literally not correlated to performance. If you look at the actual performance of these businesses, there can be shy founders that could never pitch in front of a live audience who have amazing businesses because they know their customers well. So that's really what matters, is build something and get customers excited about it, and the money should come.
We have an audience question. I think Jim is going to grab it unless I'm interrupting.
No, that's okay. Let me call it up here. This is from an anonymous attendee. I would argue that VC gets a, quote, artificial subsidy, unquote, from monetary and fiscal policies that pump hundreds of billions in liquidity into global markets. This inherently biases investors to look for investors committed to greater, faster growth. No?
Yes, but that subsidy applies to all assets in the economy equally. And what it does is it speeds up the maturation of the venture asset class. And so this is why I think a lot's been written about hedge funds and growth funds coming into the software financing ecosystem. This is why that's happening, because when you have a fund that has a hurdle rate of like 14%, like I don't need to have a 70% returning fund or a 7x fund. I only need to earn 14% a year. It's actually pretty easy to come in and pay higher valuations. But this is kind of happening across the board, across a bunch of different assets.
All right. So we were talking about diversity, and then we were sort of like started to get into the crowdfunding thing and talking about how it's like really more useful for marketing. I'd like to go back to that and just talk for a little bit about whether or not crowdfunding in and of itself will eventually become something that is a sort of sustainable revenue stream, or how that could possibly function. Is that going to be important in the future, or is it another data point similar to the, my QuickBooks login showing that like people are engaging with me? Is that, what it's going to be, or is it going to be something more?
Yeah, it's a great question and hard to give a definitive answer to, but here's my thinking. crowdfunding didn't exist 10 years ago. It wasn't legal, actually. We had to change the law in order to make this happen. So we don't have a lot of historical data from which to judge. I think it could be argued that it got off to sort of a slow start, and it's still very, very nascent. I think the estimate is that something like $500 million will be invested that way this year in the United States, which, as we already indicated, is less than 12 hours in the VC land. So it's very, very small. It may not be for everyone. That is a given. On the other hand, the growth has been tremendous. I mean, it's been sort of 70% year-on-year growth for the last few years, and I think it does have lots of advantages, as with C combinator, and also I think it's one more piece of evidence of a growing appetite among, even kind of everyday investors to have a piece of very, very early stage companies, and that trend will definitely continue. I mean, that's the sort of Shark Tankization of America, right? And like that's not going away. Whether crowdfunding becomes the most important expression of that broader trend, we'll see. But I think that, and then I mentioned in my piece various other ways that people can now invest in very early stage companies. There's Equity Zen, where you can, the minimum investment I think is usually $10,000, but you can buy into a pre-IPO company that traditionally you could only get access through a friends and family program. You're basically buying up shares of people who are selling them before the company makes an exit. And that's a growing trend. There are even these microsites that are so amazing that will let you invest in like the coffee shop down the street for $100, and now you're not going to make more than $30, and it might take 10 years, but it's a form of participating in these businesses that is both new and I think all representative of this trend of people wanting to be part of early stage companies, which I think is really interesting.
I just want to add to that so I was an investor in AngelList back in the early 2010s when I was at DFJ, and they were really pioneers in creating. They helped to create the Jobs Act, but they were pioneers in creating a crowdfunding platform that made kind of economic and commercial sense. What I would say is from that era, it was just a little too early. Like commercial adoption of SaaS was too low for you to know what's going on. So to this day, if you go to a platform like AngelList, you'll see a listing of a company, and it'll have a description that sounds awesome, and then you want to click in, dig under the hood, read the equivalent of a SEC filing like a 10K, see an income statement, and like you can't. So it's pretty hard to make an investment decision when you can't see data. This is now changing for the reasons that I mentioned. And so I think crowdfunding, I would separate out the understanding what a business does with rigor from where the money comes from. I think what we'll see first is, because of these SaaS systems of record, it'll be possible to understand with rigor exactly what businesses do and what they're worth, and what they need to fuel themselves efficiently. Then I think the money will first come from, kind of like I mentioned before, these institutional sources that have low cost of capital, that are used to in the public markets paying 5 basis points, but in the private markets paying 2 and 20, i.e. 60% fees in some cases, to access these underlying investments. So that's going to happen. Then I think what's going to happen is then crowdfunding will take off. So there's it's pretty well known that in the U.S. at least half, or the number of publicly traded companies has halved over the last 15 years. What ends up happening is companies that in the early days went public and experienced tens and hundreds of times of value appreciation, powering the individual saver and their retirement account, now are no longer accessible to individuals. They're occurring in private funds where you have to be an accredited investor to access. And so, the various time periods over the years, the House Financial Services Committee is like super interested in this stuff. Mechanically, just thinking about the companies we interact with, it's pretty hard to convince companies that have abundant sources of private capital to go public. So I think what's just naturally going to happen is these crowdfunding platforms are going to draw the same kind of capital from individual to company that public companies, IPOs, et cetera, used to. but you've got to understand what's going on. And when you're not SEC registered and you don't have to publish an income statement, it's very difficult to understand that. So that's where this SaaS kind of analytics picture of these businesses comes in as an enabler.
I would add that last year and this year, the SPAC situation changed that a little bit. I mean, you have actually a lot of IPOs this year, but they're almost all through SPACs, which again is sort of in Meg. I don't even know if I showed you the original draft of my story. It went into some on at some length about the success of IPOs this year proves that IPOs are dead, because it's all happening through SPACs. Like no one this year has done a traditional, obviously not no one, but it's like the trend that Blair's talking about has continued. It's just that SPACs have been a kind of distortion on top of that. But I think the long-term trend that you're talking about is right.
So I feel like you're pitching like on the third part of the thing, so we can talk about that.
I have to wait till I get paid for the first two.
That's true. Well, we have your invoice. It's all good.
Filed in the cloud.
Filed in the cloud. I think I want to ask the like very, very big question that it's almost a dumb question that you can't possibly know, but I would like you to try to answer it, which is just what is going to happen to traditional VC? Like what is going to happen to them? What is next?
Yeah, so I mean, I want to hear Blair's answer as well, but I'll take a stab at it. I mean, I think it's been pretty clear for a few years, and I think Mark Andreessen has been quoted saying this, that you'll have a certain kind of specialization that happens where you'll have smaller firms that are really, really experts in AI or really, really experts in crypto or whatever their field is, and almost all of their investments will be in that space, and they will have the most intelligent, most informed people in that space, and they will continue with the 220 model and all the traditional aspects of VC. That will probably continue, but the general VC firm may kind of go away, or to Blair's point, it changes the rules so that it kind of gets eaten up into other asset management classes, and I think that's probably right. I obviously don't think that Sandhill Road is going to implode tomorrow. I don't think that venture capital will truly die. But it is evolving to a point where it's arguable whether it's actually still venture capital, right? I mean, again, technically now Sequoia, Andreessen Horowitz, SoftBank, these are not actually VC firms anymore. That to some degree is a technicality or a semantic issue, but it's also quite real. And I think that it'll be very interesting to see how the Sequoia experiment pans out, because if they know what they're doing, and historically they kind of have, then they're going to be massively successful at it. I think it's going to allow them to do a lot of things that they have not been able to do historically. And if that works for the limited partners, it could be a very different company in 5 to 10 years.
Yeah, I just want to echo that the specialization is real. So when you're starting a business, there's nothing more helpful than having a community of people you can go to who have done it before in your space, who see a lot of businesses like yours and can help you see around corners. And that is like the most important ingredient to infuse into your business when you're getting started. That experience, that knowledge. You may have some if you come from the industry, but fundamentally investors who see new companies get started every day can add material value. Those specialists will probably continue to monetize, pay for the efforts by taking relatively large stakes in early stage companies, and it's totally worth it. I would advise like every company getting started to go find the smartest people in your space and take money from them. What then will happen is somewhere between the Series A and the Series C, as your company succeeds and produces the data to prove that, financing becomes commoditized. It's not really about expertise, it's about the lowest cost and the most flexibility. And so, intelligently accessing over 50,000 institutions, including insurance company balance sheets, endowments directly, et cetera, is the way to go. So what will happen in the medium term is we'll see more shifts like Sequoia from larger firms where they're lowering their cost of capital and migrating down that spectrum, but that's not disruptive. They're not going to shift their fees from 2 and 20 to 5 basis points themselves. Literally, that just will not happen. So there will be a new breed of facilitator And I would certainly put Hum into the category that looks a lot more like the ETF. So it's just a different way, different conduit for owners of capital to access it directly to companies to access it directly. The conversation is based on data. So there's going to really be two waves. It's sort of that maturation of the industry we've been talking about now, and then there's the disruptive underlying current. And I think that's maybe a story for the next 5 years, but it's real, and it's great for society.
Any final thoughts from you guys? We're
Yeah,
drawing close on the hour.
This has been great. Thank you, Meg, for facilitating this. I would just we danced a little bit around the diversity question, but I think it's a point where maybe it's just so obvious that it doesn't have to be said, but I'm going to say it anyway. And that is that, you know, it's no secret that venture capital is one of the least diverse industries, to the extent that it is an industry in the world, or certainly in the United States. And we see that in what gets funded. I think that was your point about news being what happens to the editor. Like the people that venture capitalists give money to tend to look a lot like venture capitalists, and they all went to Stanford, by the way. That's one reason why these other paths of funding have a really strong potential to go to entrepreneurs of color, female entrepreneurs, to Blair's point, entrepreneurs who don't live in New York or California, and who knows, you know, how that could change things. I mean, if it really pans out that way, and again, all these numbers are very, very small, and all these trends are rather new, but projected over time, the investing universe could look a lot different in 10 years. So
Yeah,
I didn't want to miss that point.
I think one of the questions that that I put into your piece when I was editing it, I was looking at some of the numbers and saw that the Y Combinator class, the most recent one, which I could easily find data, did have more founders from outside the US. That was something that was increasing. But despite that, there were literally more founders from outside of the US than there were women founders.
Yeah.
So the geographic problem seems to be being solved at sort of a higher rate than gender discrimination in the industry. And I'm wondering, you know, what is the big change that's going to fundamentally alter that? Because I mean, you have 52% of the population and like less than 10% of a Y Combinator class. That strikes me as dramatically not okay.
Yeah. My best guess is that change will come from female-led VC firms that you know, they may or may not specialize in investing in sort of female products or female services. But it's real. The pace of change at traditional firms along gender lines is so slow that it's really, really hard for me to imagine that changing, you know, in the next few years. Again, starting off a very small base, and it's I don't even know what the right word is. I want to say tragic, but it's something like that, in the sense that it's a missed opportunity. I mean, there are obviously lots of female-led businesses that could be very, very successful with some kind of funding, and maybe VC is not even the right way to go. Is, you know, one of kind of Blair's points, but I can't see it coming from any other place than a female-led firm, of which there are a few.
Yeah, it's just a cultural shift. I mean, it's such an easier problem to solve than geographic or ethnic or racial issues in financing, because there are literally just tons of women who went to Stanford who are as qualified as the men who went to Stanford at these venture capital firms. And I've worked with some of them, and they're just incredibly awesome. There's just literally no difference. So I think Jim is right that that's a more tactical issue. Like, that just needs to be solved. I think what I'm more talking about, the data making, the geographic barriers go away. That's sort of a second order. That is a harder problem to solve. It does require more data. We're ultimately going to run into limits of, you know, the interest in becoming an entrepreneur amongst certain people in certain geographies and so on and so forth. So you get into more systemic issues. But yeah, I agree with Jim totally on the female VC issue.
All right, well, we're coming up on the hour. I want to thank you guys so much for this wonderful talk. And, I really enjoyed editing the piece, and this has been great. Any last questions from the audience? This is your literal last minute
There
to
are
throw it
some
in
in the
there.
Q&A if you want to.
Okay.
There's one from Jerry Spoor. There's one from Janice.
Oh, I see them. They're appearing there. Great. Jim, take your pick.
I like Jerry's question. How does an inventor find the right like-minded CEO to source a quality management team to attract the appropriate kind of investments to successfully fund the launching of the venture? How do you match management with capitalization? Blair, that's for you.
Yeah, I mean, that is actually, I think, a pretty straightforward issue in this world of more specialized investors. And so you know who the incumbents are that did something in your space that was impressive, 10 or 15 years ago, because you've heard about them. You had to research them to come up with your company idea. You know who loosely kind of sits around your space. Most likely those people have family offices, or there's, ex-executives of those places that join boards. Like, the most productive thing to do as an entrepreneur is just make a list and then find them on LinkedIn, and just like any other entrepreneurial endeavor, don't take no for an answer, tenaciously go after them, show up in person if you have to and knock on their door, just get them involved in your business. That is a productive exercise. What's not a productive exercise is learning how to, talk like a Silicon Valley venture capitalist and make them like you. That's a totally different, exercise that hopefully will go away. But yeah, for the first piece, I mean, the internet is your friend. Just go chase them down. And it's hard. It's hard to be tenacious and start a business, but you have to do it.
All right. Anyone want to grab another one?
No, I think we should wrap it up,
We
actually.
got to wrap it up. Okay.
Yeah.
Well, thank you guys so much for this. Really appreciate it. I had a wonderful time, and I hope you all join us again.